tensions in the Middle East are taking a new twist as President Donald Trump says the United States will provide insurance guarantees and naval escorts to ensure safe passage for all tankers and other vessels through the Strait of Hormuz, intending to head off a potential energy crisis caused by the war with Iran. Now, analysts caution that the move may reduce some of the risk premium in energy markets, while an escalation of the Iran war could deliver a devastating blow to the global economy. Meanwhile, Nigeria's industrial policy agenda is being thrust into the spotlight with a plan to prioritize domestic value creation and deepen integration of local industries for global competitiveness. Now, Bismarck Rewane, the Chief Executive of Financial Derivatives, and Tilewa Adebajo, the Chief Executive of the CFG Advisory, join me now for more on the road ahead. Thank you, gentlemen, for joining us on the show today. Let's start off with you, Mr. Rewane. Now, the Middle East tensions definitely have thrown the market into revision mode. As we speak today, were you expecting the announcement from Donald Trump yesterday? And do you think these sort of insurance guarantees or the escort from the U.S. Navy can truly reassure the market of reviving a normal trade, irrespective of the heightened uncertainty?
No, I don't think so. Right? The Strait of Hormuz, 20% of world oil goes through there. It's how many? 24 miles wide. And all you need to do, you escort a tanker. Or with an improvised explosive device, I can fire into the tanker and then everything is over. So I think this is what you call afterthoughts of policy and things that were pre-planned. So I do not think that the US and Israel felt that there will be a reaction of this nature. But let us wait. You go back last year, the response time was 18 hours. Yeah. And this time the response time was 1 hour. Okay. So, and this is the difference between mutually assured destruction and solitary assured destruction. So that's one thing. Two is that nobody expected, they thought it was like Venezuela, one day it's over. No, this was not going to happen, right? Venezuela, 24 million people or something, or 20 million people. These guys have about 92 million. And this is much more structured. And during the holy month of Ramadan, it becomes like a holy war. So there's some part of martyrdom and all of that. So the thing is that how long? Short term to me is maybe 3 to 4 weeks before we begin to see some type of normalcy. Or it could be 6 weeks. But let us not forget that 5 years ago, the incursion into Ukraine was supposed to be for 1 week, 2 weeks, 3 weeks. Now we are in year 5. So when you plan for this kind of activity, you have to prepare for the downside. Yeah. So the afterthought of having insurance, right, and having U.S. Navy tankers escorting, those were not part of the plan.
That doesn't allay the fear.
No, that's so today, $85 a barrel is, the EIU was very clear that scenario of one day, everything shut down, oil remains at about $70 a barrel. This scenario we have now, right, talks about oil at 85 to 90. 90 range. But the other scenario where all hell breaks loose. And
maybe 100.
No, 125 actually, because they're talking about collateral damage. Kuwait, Oman, everybody. So now it's a different thing. And there's another risk, not just oil price. The desalination, they have water treatment. And if you go into Saudi Arabia and some of these countries and hit the water treatment for drinking water, you can bring those countries to their knees. Yeah. So there are so many things that have made. So I think that there will have to be a conversation, some kind of settlement, and I think the U.S. government is very, very sensitive to stock market values, also very, very sensitive to the price of petrol in the streets, and also very sensitive to the fact that interest rates, Federal Open Market Committee meeting is going to come, and with inflation where it is, and the fear of further inflation, in fact, the price of petrol today in the U.S. has actually, it's not reflective of this. So I think the U.S. will have a rethink and then look for a more accommodative way of handling this matter without
Mr. Adebajo, talking about how we're also revising our moods at the drawing board now, let's talk about in the last 1 week, we've also seen emerging markets under strain heavily. We've seen Nigeria's Eurobond yields tick up. For us now, African markets unpacking the layers, risk premium for oil, currency outlook, further central bank decisions, because all of this were not in the mix about a month ago. Where do we go from here? How does the picture pan out?
I don't think it's a big deal for us in Africa here, so I don't think we should make a mountain out of a molehill. The beneficiary, I think, is oil-producing countries like Nigeria, who probably might see in the short to medium term increase in oil prices to see their revenues increase. But I don't think this will be sustained for more than the next 3 to 4 months midterm. So for us, I think the challenges we faced in Africa are different in terms of controlling inflation. Most countries in Africa now are looking at controlling their inflation, bringing interest rates to check. In fact, Nigeria is even at the bottom of that pyramid. Most African countries have had their inflation issues resolved and are looking to put in growth policies. Yes, I don't think you can plan you can't be an economic planner or a business planner without factoring the oil prices into your equation to see where the oil prices would be and factor that in. So I think most analysts have factored in the downside of oil price and the upside of oil price into their equation. And for this playing out, even in Nigeria, as we begin to see the impact of reforms with the fuel subsidy being removed now, fuel prices will continue to go up and down depending on the oil prices of oil. So I think that's the reality with the new regime that we're living in. And I think the issue is to look at the fundamentals of how you're going to grow your economy and sustain them.
And Mr. Rewane, talking about the bigger picture of how we also grow our economy, we're looking at all of these influences from growth forecasts, trade balances and capital flows. If we were to look at a bull-based bear case scenario for Nigeria, for example, what does that look like?
No, I think, you see, this whole thing about exogenous shocks, how long they last, and the impact on macroeconomic stability is something that we cannot ignore. So, February 28th, right? People thought this was Venezuela, people thought this was the Gaza, you could do one or two things, but this is much more fundamental. And it reminds me of, historically, if you read the beginning of OPEC and how it was a Yom Kippur war, I think it was, and the prices went quadrupled, and Europe, the United States, and all the other economies never were the same again. So I agree that on February 28th, we looked at our price of oil, our inflation factors, central bank, all those things now are on hold. And the shortest possible scenario before you get stability will maybe about 4 to 6 weeks. I don't think it can be shorter than that. But medium term is about 8 to 12 weeks. Anything above that, all bets are off. So you go back and ask yourself fundamentally, for Nigeria, there's the question of revenues. The government will benefit from higher oil prices. The fiscal deficit will be lower, assuming that all the money is deployed there. The budget expansion will be there in terms of spending. But the Nigerian consumer is on the other side. So you have government revenue increase. You have investors who are pretty much neutral in this case. And then you have the consumers who are going to be paying more. The price of diesel has gone up by 170. Yes. The price of petrol has gone up by 100. And the 100 naira was based on the global price of $17. Now that it's gone to 85, then everybody's looking at it again.
So how concerned are you around the inflationary pressures there?
I think that last time that we had the price of petrol, now it's 936, but maybe let us give it some allowance, maybe up to 1,000. The last time we had petrol at 1,056 naira was sometime last year, towards the end of, sometime about a couple of months ago. But the transport fares, when we did the analysis, the transport fares where everything came up, right, at that time. And when the price of petrol started coming down towards the 800s, the transporters did not reduce their fares. So there's a strong correlation between when the price of petrol goes up and the knock-on effect on transport fares. But something has happened. Some of the vehicles, the commercial vehicles, are using compressed natural gas converted vehicles, where the equivalent of 1,000 naira petrol is about 250 naira this way. So we've seen that transporters and transport fares and vehicular traffic have not responded as sharply. But these shocks, these commodity shocks, are not just for Nigeria, it's across the world and emerging markets especially. So, like I said, the benefits are there, the risks of inflation, and quite interestingly, the central bank actually, instead of appreciating the currency and falling for the Dutch disease, actually depreciated the currency a little bit to keep it around fair value, and as a matter of fact, to put it in equilibrium, right? So everybody thought, oh, now that there's more dollars, okay, let's go spending. I think that is not happening. So the fiscal recklessness is bound to be reduced because the fiscal deficit, now the money is there, or the revenues will increase at least short term. Monetary stability will be there, inflation management, and exchange rate, rather than be carried away, what you will see is an increase in external reserves rather than buffers, rather than, so that Nigeria prepares for that, and yes, there will be some inflation, but it may not be as dramatic or as drastic as if we are not prepared for it and we didn't have the buffers.
Okay. Now, Mr. Adebajo, we've had several conversations around aligning our fiscal, monetary, and trade policies. But now, what essentials need to make the cut, especially when we're looking at the Nigeria industrial policy in view here? Targets that need to be made achievable rather than elements that need to be made achievable rather than aspirational there. What should we begin to prioritize under this new policy? This isn't the first time we're having such. The Renewed Hope agenda has also had the Nigeria First policy that is yet to fully unfold. So it's a lot of written words, yet implementation still remains slow to see the full picture.
Well, it's difficult to implement something that has just been announced. So what you need to do is to step back and understand where we're coming from. Nigeria has traditionally had some national development plans over the years, and I think those plans depended heavily on state-owned enterprises. And eventually those state-owned enterprises failed, and we have things like Ajaokuta, which is a big white elephant, and I think it is clear now that it is probably the private sector that can lead any of this industrial development. The last plan that was done came up when I was senior technical advisor to the Minister of Industry, Trade and Investment, and we came up with a Nigerian Industrial Revolution plan. At that point in time, when we went out on a lot of the investment engagements, what the Japanese and the Koreans told us very clearly was that we have to move from automotive policies to automotive legislation. South Africa, Mercedes-Benz and BMW manufactures all their right-hand drive vehicles today in South Africa, in Port Elizabeth, because South Africa has made a deliberate industrial policy to be able to take advantage for most of these companies to make that investment. But we have been stuck with a lot of policies, and I think what struck me then was the fact that these companies, both the big Japanese and the big Korean automotive manufacturers, told us clearly that they don't want to see policies. We need to move into legislation. So if you take a look at that Nigerian Industrial Revolution plan, one of the reasons why it failed is because it wasn't backed with legislation. That moved up to the Buhari government came up with the National Economic Growth and Recovery Plan, which they also put an industrial policy in. And within the same government of an APC, within 12 years, they've come up with 2 industrial policies. Now they've come up with this. So the question is that you have a Ministry of Industry, Trade and Investment. It's a very significant ministry. And you have to take a look at this from a holistic perspective. Take a look at Dangote Refinery now. He says he can't find qualified Nigerians to work. and he has to bring in skills from India. So the question that even if you don't have the manpower, skilled manpower, then it's a limitation on whatever policy you have. So how many polytechnics have been converted into to be able to develop skills to even support the Dangote refinery? So that is where you need to take a look at the alignment, because a lot of all these plans come through. But the fact is that, have we gone back to the last industrial revolution plan? Have we gone back to the National Economic Growth Recovery Plan to see where the limitations are to be able to focus on this? Then you also have to link your trade policy with your investment and industrial policy. We're importing $25 billion worth of goods from China every year. China is our largest trading partner. What bilaterals have we signed with the key Chinese companies importing into Nigeria to begin to manufacture their goods in Nigeria? We have an emerging automotive sector now. A lot of companies are bringing in CKDs and they're putting it together here. Even we have problems with hybrids. If you bring in a hybrid car into Nigeria, they're going to charge you big duty. But most countries, if you bring in hybrid cars or electric vehicles, it's zero duty. So these are the disconnections that we have in Nigeria that we need to resolve. So we need to take a look at what we've done over the last period and come up with something more concrete, and then back it up with significant amount of
we lack time at this
legislation.
moment, but if you were to speak to investor protection and incentives, what should be our priority right now to attract the long-term capital, also domestic funds for the industrial sector? What would that be?
I think what Tilewa was saying was quite accurate in the sense that we have a situation where we had industrial plans, Vision 2010, Vision that, and all. But the plans are well written or maybe well articulated. But to deliver on those plans, you need institutional reform that can deliver it, right? And so that we are not having situations where some things are incentivizing investors while others are actually moving against them. So I think clearly we should, what has happened was that the exchange rate was a major factor price that once that was in equilibrium, many other things have changed. Now people want to see how consistent are these guys going to be, so that legislation, policy, institutional reform, and all put together. So alignment of goals and alignment of policies are two different things. So, and there has to be some consistency and everybody, singing from the same hymn book. And therefore, what is the growth rate of the economy? 4.07. When you decompose it and look at it in different forms, how much of it is from this sector or the other?
Industrial sector,
and is it possible to grow an economy at 4, 10, 15% to $1 trillion if the power consumption per capita is 200 kilowatts per, so one of the lowest in the world. So our aspirations are, it's good to aspire, but there are some fundamental things that need to be done. Power constraint. You cannot grow an economy of this size, this population, when you're doing 7,000 megawatts and all that, or even 20,000 megawatts, you're getting nowhere. So something has to be done fundamentally to address that. Just like pension reform was a policy which helped to mobilize and push up national savings. I think that's my
Gentlemen, thank you so much for your time. Mr. Rewane, thank you so much, Mr. Adebajo. That was Bismarck Rewane, the Chief Executive of Financial Derivatives Company, and Tilewa Adebajo, the Chief Executive of the CFG Advisory.